Okay, so
Again,
I'll give you access to this as well in case you wanted to have it, or I'll put it on. I have a YouTube. I'll just put it on there in case people want to know how our hard money works. So generally speaking, hard money or private money, the makes it what makes it hard or private is not the rate or anything. It's just that it's personal money. And so the rules for lending is made by those who have the money. You know, the golden rule, the one who has the gold makes the rules. And so one of the things that is great about us is we can do what we want. We like the deal, we can fund it, but then sometimes uh it's hard to say what we're going to like because it's just what we like. But generally speaking, as well, if you got equity on a deal, it's a possible deal that we would like. We're looking primarily at the property, even though we do look at that at the owner's criteria, such as credit scores and their income and their assets that they have and derogatories or lack of derogatories. That's it's not important, but primarily we're looking at the asset itself, the property. Does it have low loan to value? 60% or 65% loan to value is generally our max. We have exceptions on that, depending on where it's at, or if we can cross other properties. That's another way to get more leverage from us is they got multiple properties. Theoretically, we can go over 100% of the value just by crossing more properties to get either a cash out or a purchase done. And exceptions are always available. It just depends on the likelihood of them paying us back, right? So it's a high net worth person or high profile, like a basketball star that's got money coming in like crazy, um, or they just have multiple properties. We can make exceptions on deals. And here's our real secret. The real secret of Jcap is if Bob likes it, we fund it. That's Bob. So he's our CEO, and we we do a lot of wild stuff because of that. So we're going to fund deals probably from 30,000 to 5 million, and we our rates are as low as 7 and 7/8 on a really short term, low leverage deal, like under 50% loan to value. We'll do first and seconds. I'm going to charge at least 1.5 points usually. We've been skinnier than that, but that's usually where I'll start with our origination. Then you get paid by adding your points on top of ours, and then you get paid right out of escrow. First and seconds, none of our deals have prepayment penalties, so you can pay us off the next day, or your borrower can, and your commission that you make doesn't isn't jeopardized because it's all borrower paid. 12 to 18 months. Usually, the shorter the loan, the safer it is for us. And so we like short term, quick payoffs. Um, we always need a valuation of some sort. Sometimes if it's low, really low loan to value, or or you already have an appraisal, often we can use that or do our own valuation if it's really safe, like low loan to value. We won't need a full one, but most of the time we get a full appraisal. They're not going to do anything rural though, just because it's hard to resell those things if someone gets in trouble. We don't have a minimum FICO, but you know, high FICO is better. But we don't have a minimum, and it, these deals are great because the broker, my goal is for you or the LO to get paid twice. And the way you get paid twice is once on our short-term bridge loan, and then secondly on the exit loan, which we want to figure out how they're going to pay us off in 6 months, 12 months, 18 months. And then you're going to, of course, do that loan and get paid again. So that's the overview. Feel free if anybody would like to interrupt me as I go along. Any
what's
questions, so to speak?
what's the typical time frame to get a deal done?
Well, it depends on the deal, how clean it is, how hard it is. Once we have value set and title clear, we could fund. So that can be done in a couple days, and sometimes things drag on to weeks and weeks. So
And will you guys look at cannabis?
no, no cannabis. No cannabis, very little commercial. I'll go into that, but yeah, no cannabis. So we're primarily a Not cannabis. California lender. But we do awesome deals everywhere. So any major metro really we'll take a look at. Um, but we prefer Southern California because that's where we're sitting and we're just more familiar with it. So, but if it's a major metro anywhere in the country, I'll take a look. Um, I'll say I won't go into this too much because it's mostly a sales type slide, but when you're selling these kind of loans, having a clear exit is also helpful for the sale because if they do have a clear, they need the money for whatever reason, and we have the money, our money is going to be more expensive than probably what they're thinking about as the exit loan, and it's definitely going to be shorter term. So when you're going to sell these hard money products, just get clear about how you're going to get them out of it. And the pitch is generally, why do you want the money? Okay, great. We can make that happen. Here's the bridge or short term or band-aid to get us from here to there, right? The bridge from here to there. And it's going to cost a lot, sure, but is this thing that you want worth it to pay this much? Because I want to get you right out of it as soon as I can. And as long as everybody's clear up front about those costs, it usually goes really smooth. If a borrower is not clear of the costs and they find out when they're signing docs, it usually does not work. So I'd be clear up front on these guys with these guys. We do have really low cost hard money, cheap hard money that starts as little as 7.875 prime minus 5/8. On these deals, though, we're pretty particular. So it's probably only going to be in Southern California, coastal areas, Santa Barbara to San Diego. I'm going to need the loan to value less than 50%, 3 to 12 month note. So shorter the deal, the better for us. We're only going to do a first. We need the credit to be 680 plus. The max loan on this cheap money is going to be 1.5 million, and we want clean credit. So, like for example, someone who just built a house and it's finished, and their current hard money lender needs paid off, we would do, and they're at 50% or less. We would give them a cash out to pay off their current deal, maybe pull out the money that they've used to build the property, and let's say it's for sale right now. So they're like, we got a lot of offers. We got to, maybe we're looking at offers right now. All we need is a 3 month note, and it's just to give us some more time. So that kind of scenario, we can get them some really cheap money. But any scenario that you have, if you let me know, there's lots of variations between 8% and 12%, which is kind of the range for a first. And I'll always price it out for you. I just need the address and what
It,
the
uh,
request is.
sorry to interrupt. Would you guys look at Hawaii?
We would, yeah. Hawaii in general is rural to us, and so we're going to be particular. Probably only nice homes in nice neighborhoods with some comps, preferably like a gated area, preferably on the water. But there's a lot of Hawaii that does not meet that description. But I'll we can look at anything, but that's the normal that we fund in Hawaii.
Is there a maximum points that can be charged?
I don't have an exact max, but once it gets to be the point where I can get in trouble for someone suing us for usury, even though that's not really a thing, then we would hold you back. But I don't really have a max that you can charge generally. 1, 2, 3 points. It's all like within reason. The deals that tend to close are the ones that match my points. So if I'm at 1.5 or 2, and you're at 1.5 or 2, those seem to be more palatable for most borrowers. But in the end, if you could sell it, you can most likely have it. Uh, Loans on listed properties. Most lenders don't like loans on listed properties, but we do just because we have no prepayment penalty. So if a property is listed, that's great because then the exit, how we're going to get paid off, is very clear. So whether we're paying off current debt, or they need to cash out to get their capital back in their pocket, or they need the money to buy another property, all those kind of things is great. We'd love to lend on a property that's currently listed. No problem. We also do owner occupied consumer loans. So there's a couple different kinds. There's owner occupied business purpose. That means 75% to 100% of the funds are going to be for a business, meaning they have a business. So if they're W-2 at the post office and they want a business purpose loan, I'm going to ask, well, what's their business? And you're like, oh, it's business purpose. Like, okay, well, what is that business? They can't be doing, it's not their post office. What is their business? And so if we can prove they have a business, maybe they have a Schedule C or they opened an entity and we're going to lend to the entity and that the debt's going to be a second on their primary, that's all fine. But that's a business purpose on owner occupied. I have to have a clear business that we're lending to, even if it's to their name, but they can show that they have a business going somehow. The other option on owner occupied homes is consumer loan. So consumer is basically that it's not a business. The money's not going to a business, or we're paying off debt that we can't prove is a business. And so that's going to be, we could do that, but now we have to income qualify. So owner occupied deals, foreclosure bailouts, a forbearance bailout on owner occupied, paying off their consumer debt, like their credit cards that are in their name, they have to income qualify. And so that means we're going to be pretty conservative. We're going to charge them 18% just for the qualifying rate. Their note rate's going to be in the 11s most likely, but the qualify rate's going to be 18% interest only, plus all the other ITI and minimum payments on credit. And we want that 45% DTI on the back end or less. So it's harder to qualify, but if they have the money coming in, we could be flexible as well. Like we usually just do 6 months of deposits on for bank statements. And we'll count all their deposits coming in, whether it's businesses that they own or personal statements. So that's a little bit easier, but they do have to show they have the money coming in. The third kind of owner occupied deal that we'll do is called we call it the consumer bridge, because they're going from one primary to another primary. And in that scenario, there's no income qualifying. So the only owner occupied loan that is income qualifying is the one that is the consumer loan. This consumer bridge, they have one house. In this example, let's say they own a house and they have it's worth $1 million and they have a $250,000 first on it, and they want to buy another house that's $1 million. And they're like, I live in this house. I want to buy that one, but I want to buy it before I sell it. So we'll do one loan. We'll do in this case, we would do $1 million first to buy the house. So it's 100% purchase loan, but we're going to cross that one loan by the two properties. So it would be $1 million first on the property that they're buying. And that same loan would be $1 million second. One loan, two liens on the departing residence. And so the combined value, if I add both homes together and both all the debt, is only 62.5%. So that's great. On these kind of deals, depending on where we're at, it would be 65 max, maybe 70. Like if it's in like Irvine or right next to us, we'd consider a little bit higher, but usually we want to be at that 65% loan to value or less. And then whenever they sell their departing residence, then they made, in this case, 750 grand, not counting costs. They pay down their debt. So now they have a $250,000 first, theoretically, or maybe more. And then you can refi that whatever debt is left into an exit long-term loan. And so we get paid off with the sale of their departing residence. This consumer bridge, they don't have income qualifying, but it is a 11-month note. And this is probably we do these consumer loans more than any others. Any questions on these owner occupied possibilities?
What's your release price on the departing home?
Well, the release.
Do you have a minimum release? And in that scenario, it looks like you required $1 million pay down, or whatever you sold it for, the profit to pay down the new home.
Well, the first thing to consider is even if we let them pay down the loan and we release it, the lien on that departing, they still only have an 11-month note. So we need to go fast. So we would probably require them to pay it down to 65%. So they would have need in this case for them to pay it down to at least 650,000. And then you'd start working on the refi. Because we don't want that one property leveraged up more than we would we would lend on. So once we lose that departing residence collateral, they need to pay it down or we wouldn't release the lien. Does that make sense?
Yeah, thanks.
But every deal is different. But in our magic deal of perfectness, 65 would probably be preferable. Any other questions so far?
On going back to one of your on the straight up bridge, where you had the example of the 7.875% first and a 13% second. Are you guys doing both the first and second? Yeah.
I don't know what you're referring to.
There.
Oh, this one.
No, maybe not. You had one where
One
it
of the
was an
earlier
example.
slides.
Yeah, it was one of the examples where it was like a first and a second. I was wondering if you guys sort of package it as where you're doing both, or that was just an example of.
They do seconds.
Oh, you do seconds. Okay, I walked in late. Okay, got it.
We
Seconds.
can do a second. Seconds go up to usually about 60% CLTV max. But I mean, if it makes sense, that's possible where we would give a first, I don't know, up to 50%, and then we give you a second up to 60, 65 CLTV. That second would definitely be higher in rate and have its own points associated with it. That is possible. That would split up the leverage a little bit for us and split up the risk. But we usually don't do that. It's usually just one alone, pick one or the other. And if we did a second, we would want the first to be a permanent loan, like no balloon payment. And so we're not going to, and I'm not going to do a second if they already are not paying their first, for example. If they're behind on their first, I'm never going to give them a second to catch them up. So it's a little bit more particular on seconds, but we can do them. But I never do them together, but I could. It's possible if it makes sense. I'm open to creativity if you have some ways to make it happen. Any other questions? That was a good one.
If they're behind on property taxes, will you still do a second?
No, we won't do a first or a second if they're behind on property taxes. We will do the deal and pay them current, but they're going to need their property taxes paid current. They're going to need their HOA, their insurance, homeowners insurance. They're going to need any judgments paid, like personal judgments, and of course, title needs to be clear. So no clouds on title. All those things we're not going to be at risk of any of those things that can take priority over us lingering. We will do this. This is good. You feel free to interrupt me as we go along too. You don't need to wait. We will do bailouts as well. Now we're pretty particular on a bailout. This is a bailout buyback. This is a theoretical product. I'd actually never done this because it's a bad deal for the consumer. I always talk people out of it. But theoretically, if you have a consumer that can't get a hard money on their primary home and they're going to lose it and they don't have a lot of debt, we could buy the home from them at whatever the debt is that they have, and then contract with them to sell it back to them within a year or two, so that they can stay in it. Now, I always talk people out of it because it's a bad idea in general, because they're selling to us at a discount. And if they default on their now lease, because now they're not the owners, we would be the owner. And if they default for whatever reason on their lease, we would evict them and take the home. It's not even a foreclosure anymore. It's an eviction because they don't own it. But theoretically, if people have a strong personal attachment to their home, which obviously is easy to do, and there's no other way to get them to stay. We would take a look at the home and buy a home up to a certain amount, and then lease it back to them. We would then sell it back to them within a set amount of time in the lease back option, at least a 20% premium. So let's say we lent them $1 million, their payback in a year or less would be 1.2 million. So it's pricey, but it's an option. So moving on from owner occupied deals, we're talking about fix and flip now. We don't do a lot of construction, to be honest. We're mostly just bridge loans, but we can get these done. And the general equations or the ratios that we're looking at is what's the loan to value currently. So if they're buying a home, the loan to value is the purchase price. When you're renovating, now you have a purchase price and you have the budget. So if it's a $500,000 purchase, the acquisition, you got 500,000 purchase, and then you got a 500,000 rehab. The total cost is now $1 million. $1 million. So now we're looking at loan to cost. So loan to value has to do with just the as is value. The loan to cost has to do with the total cost to finish the project. And then the loan to after repair value, that ARV, has to do with the loan as a percentage compared to what it's going to be worth when you're done. So all of those, every deal has a different max leverages, but we're generally going to go 85% max of the loan to cost, 80% max of the purchase price, and up to 70% max of the loan to the after repair value. And so it's pretty easy if someone buys well to get 100% of the budget covered and 80% of the purchase. So that would be called an 80-100, and we could do that. But every deal is its own, and the thing that gives you the most leverage is good credit and also experience more than anything. It's, do they have deals in their name in the last 3 years? And so you'll have these contractors that have grown up and done hundreds of construction deals, but none of them were in their name. They're always doing it for other people. So in that scenario, their experience is zero, even though they're a skilled laborer. So we want to know how many they've done in their name. And then sometimes people will add partners to get it done, have experience, or add partners into the deal that have the money. All those things can be added in there, and then we'll look at their assets and so on. So that's fix and flip. Generally speaking, if you have a fix and flip deal, give me the address, what their experience is, credit, the budget, purchase price, and if you send me the wrong thing, I'm just going to email you back the other stuff that I need. So it's not a problem. Cash outs. Most of what we do, even though we can do all that stuff, is just straight cash outs. People that have a property with equity and they need money for whatever reason, and they can't get it cheaper, so they'll come to us. So we'll do firsts up to 65 or so. We'll do seconds up to 60% or so. We usually only lending on 1 to 4 unit residential properties. We can do these cash outs on commercials, but we're going to probably be 55% on a commercial property. We can increase that leverage by crossing with other properties, and we can do seconds if you don't want to touch their first, as long as the first is a good standing and they're not behind or have a history of default. And
For commercial, are you gonna look and see if they're allowed to take out a second?
we're probably not going to do a second on a commercial property. Yeah, I would most likely not. Seconds are only for residential for us. I can't.
And do you consider,
Go ahead.
sorry, do you consider commercial like a multifamily commercial?
1 to 4 unit residential
Multifamily
is
5+ units.
right. So just like when you're thinking of a conventional or an FHA or VA loan, what they think of as residential is what we think of. What they think of as commercial is what we do. So 5 plus residential, and retail and office and industrial, all the other commercial type properties. We would look at it the same way. And our loan amounts for commercial, if we did one, probably $1 million to $5 million. if the loan they need is less than $1 million, well, then we'll have to look at it really carefully because we're probably not going to do like a low value commercial place. Most likely, we gotta like the property in general. But mostly when we're looking at a commercial deal, we want to see that it's stabilized. We're not going to do a renovation on a commercial deal of any kind. If it's stabilized and it's cash flowing and the cash flow from the property can easily pay our loan payment, that's probably the first step that we're looking at initially. But we'll do 5+ multifamily units. We'll do light industrial. We'll do a retail center. We're probably not going to do a church, no school, no strip club, probably not going to do assisted living, all these specialty type properties, especially if they require licensing to run it, like assisted living. It makes it more difficult for us to say yes to. No cannabis, probably not going to do anything auto or anything that has environmental issues or possible, like heavy industrial as well. So we don't do a lot of commercial, but we can. It's a good deal. Any other questions up to this point?
We probably need to start wrapping up a little bit.
Oh, great. Yep. This is the end.
Okay.
So here's what I would do when I was doing retail loan officering. I had to save the loan checklist. And if you're in a deal, it was always hard for me to think outside the box because I was too close to it. So your checklist is basically all the stuff that you know how to do to save a deal. There's nothing worse than losing a deal when someone else closes it and all they did was add a cosigner. You're like, why didn't I think of that? So start writing it down. I don't know what your save the deal tactics are, but I would add, will hard money help to that save the deal checklist, and you'll be surprised how much you can forget when it comes to losing a deal. So refer to that whenever you're losing a deal. Recap. If it's low loan to value, we could probably do it. If they have other properties that can get them the loan, we could probably do it. And if they're really strong borrowers, high net worth, high profile person, could probably do it. If it's in a major metro, we definitely could take a look, and it's low loan to value, we could do those. Get out of a problem, take advantage of an opportunity, and they can't get the loan elsewhere. Well, that's where we come in as private money. So whatever the scenario is, if you got an address, email me the address and what they want, and I could take a look and I'll let you know right away on what we can do. And then if you have questions as well, you can also email me or call me. But my email is javon@jcap.net. And that's it.
Perfect. Thank you so much, Javon. This was super helpful. I'll make sure everyone has your contact information. So if they have any scenarios they'd like to run by you directly, they can do so.
Wonderful. Well, thanks for having me.
Does anyone else have any final questions?
Thanks, Javon.
All right, I think we're good.
Thanks, everybody.
Thanks so much, Javon. Yeah, thanks.
Bye-bye.
Bye.